In 1666, the city of London burned. It started in a bakery on Pudding Lane at 2 in the morning and consumed 13,000 homes in 4 days. The people who lost everything had no way to recover. No mechanism existed to distribute the loss. If your house burned, you absorbed the entire cost alone. A man named Nicholas Barbon looked at that catastrophe and saw something different from what everyone else saw. He did not see tragedy. He saw a market. By 1680, 14 years after the fire, Barbon had established what historians recognize as the first property insurance company in England, charging homeowners a small annual fee in exchange for a guarantee of rebuilding if fire destroyed their property. It was a genuinely useful invention. It pooled risk across thousands of people so that no single person had to absorb a catastrophic loss alone. For 340 years, that core idea has not changed. What has changed, dramatically and systematically, is everything built around it. According to the Insurance Information Institute, based on data from the National Association of Insurance Commissioners and S&P Global Market Intelligence, U.S. insurers collected approximately $1.7 trillion in net written premiums in their most recent reported year, across property, casualty, life, and health sectors combined. $1.7 trillion. That exceeds the entire GDP of Australia. It dwarfs federal spending on Medicaid. It is a number so large it has stopped feeling like money and started feeling like weather. Something that exists, that falls on you, that you cannot meaningfully influence. Insurance is among the largest recurring household expenses most Americans carry, and among the least understood. Auto, home, life, health, disability. Most households are managing multiple policies simultaneously, often without a clear understanding of what each one actually covers, what triggers a valid claim, or how the premium was calculated. They are paying every month for a product most of them have never fully read. And the industry that sells it is structured in ways both legal and technical to ensure that asymmetry persists. To understand the insurance trap, you need to understand a concept called information asymmetry. It was formalized by economist George Akerlof at UC Berkeley in a 1970 paper titled The Market for Lemons, for which he later received the Nobel Prize in Economics. Akerlof's core insight was this: in any market where one party has significantly more information than the other, the party with less information will consistently make worse decisions and will pay more for less value without ever fully understanding why. The used car market was his original example. The seller knows whether the car has problems. The buyer does not. That gap, not malice, not fraud, just information, systematically disadvantages the buyer. Insurance is among the most extreme examples of information asymmetry in the modern economy. The insurer knows, precisely, actuarially, to multiple decimal places, the statistical probability of the event you are insuring against. You do not. The insurer knows exactly what language in your policy will support a claim and what language will limit or deny it. You do not. The insurer has teams of underwriters, actuaries, and legal professionals whose full-time job is to price risk in the insurer's favor. You have a document you agreed to without reading it. And in the United States, this asymmetry is compounded by a fragmented regulatory structure. Insurance is not federally regulated. It is overseen state by state. 50 different rulebooks, 50 different approval processes, and 50 different consumer protection standards. That fragmentation does not primarily protect the buyer. It protects the complexity. Consider a scenario that appears in some form in consumer protection filings across the country every year. A homeowner, call him David, has paid property insurance premiums for 17 years without filing a single claim. After a severe storm, his roof sustains significant damage: water intrusion, structural compromise, interior ceiling damage across 3 rooms. He files a claim. The adjuster arrives, inspects, and submits a report. The claim is partially denied. The insurer determines that a portion of the damage is attributable to gradual deterioration, a standard exclusion in most homeowners' policies, rather than acute storm damage. The line between those two categories is determined by the insurer's adjuster, using criteria the homeowner has never seen, applying language the homeowner has never read, in a document signed years earlier without fully understanding its limitations. Out-of-pocket cost after the partial payout, $11,000. 17 years of premiums paid. First claim filed. Partial denial on technical grounds the policyholder was never equipped to anticipate. This is not a story about fraud. It is a story about a transaction in which one party understood the terms and one party believed they did. The distinction matters because the second situation is far more common and far harder to see coming. In 2025, the California Department of Insurance took formal legal action against the state's FAIR Plan, a last resort insurer for high-risk properties, citing 418 documented violations related to the denial of smoke damage claims following the Los Angeles wildfires. Not alleged patterns, documented violations. 418 of them in a single enforcement action, against a single insurer, in a single state. The gap between what policyholders expect and what policies deliver is documented across multiple insurance categories. In health insurance, which operates under its own distinct regulatory framework, the Kaiser Family Foundation's 2024 analysis of industry data on ACA marketplace plans found that approximately 19 to 20% of in-network claims were initially denied, with out-of-network denial rates running significantly higher. In property and casualty insurance, the pattern takes a different but structurally similar form. A 2023 investigation by ProPublica, followed by state-level audits in 2024, found that several major property carriers had deployed software-driven estimation tools to generate initial repair valuations. This is not a new development. In 2010, Allstate reached a settlement of $10 million with 45 states over concerns about its software-driven claims handling system, with regulators finding that the approach created, in their words, special monitoring issues around fair claims treatment. The tools have grown more sophisticated since. The underlying dynamic has not changed. To be precise, these tools are not automated denial systems. Final claim decisions still require human review under most state laws. But documented audits show that the baseline payout figures these tools generate often fall significantly below what independent contractors estimate for identical damage, creating an opening number in the negotiation that the policyholder is rarely prepared to challenge. These are not isolated incidents. They are documented patterns across different policy types and different states. And the mechanism behind them is not corruption. It is optimization. The insurer's financial interest is to collect premiums and manage payouts efficiently. Your financial interest is to receive a payout that covers your actual loss. These interests are structurally in tension, and only one side of that transaction arrives professionally prepared. Here is the line the industry never uses in its advertising. You are not buying protection. You are buying access to a negotiation. Think of your policy not as a shield, but as a rule book written by the other side. And the terms of that negotiation, the exclusion clauses, the claims adjustment process, the appeal procedures, the software-driven estimation tools, were written entirely by the party on the other side of the table. Your premium buys you a seat in that negotiation. It does not guarantee the outcome. Most people discover this distinction at the worst possible moment, in the middle of a loss, when they are least equipped to fight. Now here's the psychological mechanism that makes this trap so durable. Insurance is sold primarily through fear. Not malicious fear, actuarially calibrated fear. The industry understands, with precision, that humans are loss-averse. We feel the pain of a potential loss more intensely than we feel the benefit of an equivalent gain. Daniel Kahneman and Amos Tversky documented this asymmetry formally in their Nobel Prize-winning work on prospect theory. The industry did not need to read the paper. It had been operating on the same principle since Barbon's London office. The advertisements do not sell you a product. They sell you a mental image of what happens without the product. The house fire, the car accident, the medical diagnosis without coverage. Your brain processes those images as probable threats, not because the actuarial risk is high, but because the emotional vividness makes the scenario feel imminent. And in the gap between perceived risk and actual risk, a significant portion of the industry's most expensive products are sold. The research on insurance purchasing behavior reinforces this. A 2019 study published in the Journal of Risk and Insurance found that consumers consistently overpay for low-deductible policies, choosing to pay significantly higher premiums for coverage of small, frequent losses. The losses they are most financially capable of absorbing themselves. The premium for low-deductible coverage is, across most policy types, substantially higher than the expected value of the additional coverage it provides. Most people are paying extra to insure against losses they could afford to cover, while simultaneously underinsuring against catastrophic, low-probability events that can genuinely destroy a household's financial position. The industry does not create this cognitive pattern, but it prices its products around it. So what does the evidence actually point toward? Not abandoning insurance. Not self-insuring against risks that can genuinely destroy your financial position. 3 frameworks, drawn from risk economics and consumer protection research. These frameworks apply most directly to property, casualty, and life insurance. Health insurance operates under a separate regulatory structure, with employer-sponsored plans governed by federal ERISA law, which preempts many state-level consumer protections and limits your ability to sue in state court. That ecosystem deserves its own dedicated analysis. First, read the exclusion clauses before you read the coverage, and consider working with an independent broker. Most people buying a policy read the benefits section and stop. The exclusion clauses, the list of what the policy specifically does not cover, are where the actual terms of your protection live. A homeowner's policy that covers wind but excludes flood. A life policy with contestability clauses. A property policy with gradual deterioration language broad enough to absorb a significant portion of storm damage. These are not supplementary details. They are the product. Before purchasing any policy, the most valuable 30 minutes you can spend is reading every exclusion clause in sequence. And where possible, work with a state-licensed independent broker, not a captive agent tied to a single carrier. An independent broker is not legally a fiduciary in most states, but they can compare exclusion language and pricing across multiple insurers in ways a captive agent cannot. That shifts the information balance meaningfully in your favor before you sign anything. Second, raise your deductibles on small loss policies and self-insure the difference. The research on consumer insurance behavior consistently shows that the premium reduction from raising a deductible significantly exceeds the expected cost of the additional out-of-pocket exposure across auto, homeowners, and certain other policy types. The household that carries a $2,000 deductible instead of a $500 deductible and deposits the premium difference into a dedicated liquid account is, in expected value terms, in a stronger financial position than the household paying for low-deductible coverage. This logic does not apply to catastrophic loss policies, serious illness coverage, long-term disability, high liability exposure. It applies to the policies covering everyday losses you are financially equipped to absorb. Third, document everything before you need to file and know your appeal rights before you need them. The single most effective thing a policyholder can do to strengthen their position in a claims negotiation has nothing to do with the claim itself. It happens before the loss. A complete home inventory, photographs, serial numbers, purchase records, stored off-site or in cloud backup, shifts the information asymmetry in your favor the moment a claim is filed. And if a claim is denied or undervalued, most American policyholders have formal paths they rarely use. An internal appeal with the insurer, an external independent review mandated in most states for health and many property policies, an appraisal clause in most homeowners' policies that triggers a neutral third-party valuation when you and the insurer disagree on the loss amount, and a regulatory complaint through your state's Department of Insurance. These are not workarounds. They are rights built into the system. Most policyholders never exercise them because they never knew they existed. Nicholas Barbon's invention was genuinely useful. The pooling of risk across large populations remains one of the most powerful financial mechanisms available to individuals who would otherwise be financially destroyed by a single catastrophic event. That has not changed. What has changed is the complexity of the products built on top of that core idea, and the distance between what those products are sold as and what they actually deliver when the moment of loss arrives. The industry is not built on fraud. It is built on complexity. And complexity, in a market with structural information asymmetry, functions like a tax, paid disproportionately by the people who understand the product least to the people who understand it most. That tax is not entirely avoidable, but it is substantially reducible. And the first step is to understand what you are actually buying before you sign the document that determines what you will receive. This is the final episode of the Economic Trap series. 8 traps. 8 systems. One consistent pattern across all of them. Complexity is priced in someone's favor, and for most of the people inside these systems, that someone was not them. The reputation economy, the intelligence trap, the salary trap, the ownership gap, the starting trap, the debt trap, the healthcare trap, the attention trap, the credential trap, and now the insurance trap. Understanding the mechanism has always been the first form of power. Now you have seen all 8. The complete playlist, all episodes with sources and frameworks, is linked below. Save it, share it, use it. What comes next on this channel is something different and something bigger. Stay with us